So the track record, why invest in stocks? So this is something that is overlooked commonly. And the truth is, stocks have an incredible track record. If you just look at S&P 500 index fund, since 1957, they had an average annualized return of 10.5%. Now that is to 2021. That's actually when I made the presentation. So there is a downturn in 2022, but at the same time, the track record is pretty impressive. It's almost 60, 70 years of 10% annualized returns. Now the big nuance here is that someone did not sell during the downturn, because that 10.5% could be completely eroded really quickly due to one or two bad time sales. So that is definitely a pro for traditional assets like stocks. Now, accessibility and liquidity. When I got started, I remember you have to go to your brokerage and kind of make the trades and stuff. These days, you have an app. You can get on, make a trade within seconds, and have your money, move it in and out. And that's definitely a positive for a part of your portfolio. And the key here is that liquidity is a positive for a part of your portfolio. And we'll get into the negative part about it as well. Then it's low cost. If you're just starting out and you're 18 years old, 19 years old, and you got a first-time job, you could put $1,000 into an index fund versus the alternative investments. Usually the minimum investment is $50,000 or more. Time commitment. So this is if you don't do individual stock picking and follow the market, you could literally just buy the index fund, set it, forget it. In 20, 30, 40, 50 years, it's probably going to be worth a lot more than it is today. And you do not have to waste any part of your time following those stocks. Now, if you do individual stock picking, that's a little bit of a different story. But my goal is to basically talk about the pros of the strategy that I use, which is just the index fund. Next one is the one that I feel like that is most overlooked. So collateralization. So a lot of real estate investors love the infinite banking concept, and they use these life insurance policies because they're middleman. The way that I work with my brokerage account, it's exactly the same way. So what they do is they collateralize my index fund and they give you a line of credit for it. Now it's a line of credit, not margin. So it is a little bit of difference, and usually have a pretty safe margin because they only give you 50% of what you have. So unless the market really goes down 50, 60, 70%, you don't get into margin calls. So it's really important that you could actually invest in stocks, collateralize the stocks, and then use that money to actually go invest in real estate and alternative assets, which is one of my favorite strategies. Next is social norms. This is just the simplicity of the fact that if you go to a barbecue, most likely they're not going to be talking about, the latest apartment building investment, but they may be talking about Tesla and Bitcoin and stuff like that. So in terms of social norms, it's easier to have a conversation with someone if you invest in stock versus if you do alternative investments.